99% of people go about fundraising the wrong way. They're chasing investors, giving away too much equity, or just getting a bad deal. We currently manage a 9-figure portfolio of companies and have done multiple exits amongst our group. And in this video, I'm going to show you the 10 best ways to fundraise to make your company the most money while keeping your ownership. So the most important thing when it comes to raising capital is understanding your capital stack. And your capital stack, when it comes to external funding, typically starts somewhere around here. It looks like a triangle. And you have senior debt, you have mezzanine debt, and then you have junior, and it goes down, right? And then you have, equity and other structures, and we're going to go into it. But in general, when it comes to raising capital, the best way to get capital for your business is to go and make sales, okay? Generate some revenue, go make sales, bootstrap a bit. That's the cheapest and best way for your business to get money in the door. It's to actually sell what you're selling. The next best way is for grants. So there are services. I've seen a nice woman on LinkedIn do the same thing. I'm forgetting her name. She has a whole business model around helping people get grants. The thing about grants is it's not fast, but it's the freest money you'll ever get. There's no payback. There's no interest. The government gives you money. They don't take equity in your business. They're giving you money simply because your business does a certain type of thing that allows you to qualify for a grant. Typically, it'll take 8 to 10 months to get the grant. So it's not a quick money fix like some of the other financial products that you could get as a business owner, but it is a good way to get money in if you have a longer time horizon and you can afford to wait and not actually have to raise that capital immediately. And obviously there are certain maturity phases in a business that make having access to certain types of financial products here easier. In general, after grants, you have revenue-based financing options, you have some merchant cash advance people, you have a lot of credit-based financing where you can do like credit cards. I actually have a very great company called Stacking Capital that we use for all of our clients, where they actually just help people credit stack for multiple funding rounds. So they can actually help you refinance at close to 0%, if not 0% interest rates multiple times. They have a whole process around this and they've been doing this so well. I think they did 18 million in the past 12 months in just loans given or lines of credit given. So there's ways to basically finance your business through your credit score, and also obviously just traditional loans, and they're going to hard money you. So they're going to charge 12 to 20, 30% on those loans. And then merchant cash advance guys are like 30 to 60% for shorter term loans. You also have payroll loans, you have factoring. So there's a ton of different ways that you can do revenue-based financing. And then you have bank debt. This is like the traditional type of application that you do with SBA. There's tons of different types of SBA loans. There's emergency loans. There's some that go up to $5 million. But all in all, once you start doing SBA, there's also other Ascension programs where they give you more and more debt depending on the types of assets you have in your business at lower and lower rates, typically because you're just such a good borrower and you have a great credit score and a great business credit score and you're just crushing it. So the banks love to work with you, but it takes time to get that kind of relationship. I think Stacking Capital actually does that. They're pretty good at this type of stuff. So highly recommend you checking them out, especially if you're a startup founder. They can get you lines of credit that are really, really good. A shameless plug, right? But they're really good. Patrick's amazing and he's phenomenal. He's one of the best people in the space, and that's why I'm so confident to just talk about him here. Then you also have venture debt. Venture debt is kind of like this weird split where VCs will give you a loan where maybe there's like a balloon payment at the end. So you pay like all your, you have no payments, or maybe you have some low amount of payments. And then at the end of the thing, there's this, balloon payment, sometimes called a PIKE, pay in kind, where you pay the majority of your principal and interest at the end of the term. So this could be like a 7 to 10 year term. Sometimes it could be 3 to 5 years. It just depends on the lender, and it depends on your ability to negotiate these deals. That's something that your head of finance or CFO should do. We do that for some of our clients, depending on how mature they are and whether we're willing to risk our relationships to, back a client, especially new clients. It takes a little bit more time. We want to see how they work. We don't want to ruin a reputation. Yeah, overall, there's different ways to get venture capital debt and not actually have to give up the equity in your business, right? Then you have convertible notes and safes. This is similar to venture debt, but with the convertible note, it gives the lender the right to flip it to equity. And typically what they'll do is they'll put a cap on your equity. So they'll say, okay, the company, we want 25% of the company at a $4 million valuation, which means that we're going to give you $1 million at X%. And over the course of whatever, there might be a period where you do an actual like Series A round and the lender or the investor has the ability to convert their debt with the interest into that post-money valuation or pre-money valuation. So if you raise at 20 million, they can say, all right, well, I was making, 7% here, but 20 million is 5x on my original investment, and I have the right to convert it. So I'm going to convert it on that round. It turns into equity later, and it can be a little bit more expensive for the founder depending on what their goals are. Then you have preferred equity. So there's just special rights and treatments in there. It's better than common equity, but this is kind of like the gray area where it's like, okay, are you common stock? Are you preferred stock? What's the special treatment? What voting rights do you have in the company? And then common equity is the lowest tier of equity. And that's just, the shareholders typically have a minority stake and they don't really have many rights compared to anybody else on this capital stack. Debt is always senior to equity. And as a result, the return to risk is a little bit less. There's more risk on equity than there is on debt. So that's just something to understand. And when you're doing these types of deals as a business owner, you need to understand whether you're a momentum company or you're a mean reversion company. And these two decisions have to be made before you really start the business or after, a 3 to 5 year cycle, if not 7-year cycle of just running the original business, right? We want to know whether we're growing for that OpenAI, massive IPO, SpaceX, billion-dollar potential. You're willing to just keep burning money because you know that the outcome of a public event, some type of massive liquidity event, is just so much better than any amount of money that can be given into your company today. And the investors also know that too. Then you have mean reverting companies. These are your typical service businesses, roll-up strategies, healthcare, dental practices, whatever it is, just very consistent, stable cash flow that lenders love to lend against because they know they're going to get their money back. There's some collateral, there's a personal guarantee sometimes or most of the time, and they're happy with it. It's all about reducing risk and, getting paid the appropriate amount of risk premium for reducing that amount of risk, right? Then you have debt versus equity, right? So as we said above right here, if you're doing debt as a lender, it's safer, you have more rights. If you're doing equity, it's more risky, but there's more upside. But from the business owner's perspective, most founders are actually really scared of debt. And this is because if you're a first-time founder, you don't have a lot of money or you're just coming from a world where, marketing was done for you. You don't have to really worry about your business, like people coming in and actually like having work to do. In fact, there's a lot of work for you to do. And you're now scared of debt because you're thinking like, oh man, I'm in debt. I'm personally liable. Like if this fails, which is the truth, I can go bankrupt. But the reality is if I borrow $1 million at some fixed rate, let's say 6%, and then we have a situation where rates go up and now interest rates put this note is now worth 9%. You actually made a 3% spread on your money, right? And you're working this capital and you can generate a positive return on the money that the lender gave you. That's the whole reason why you're in business in the first place. It's to make money. It's not to lose money. It's not a charity. You're here to make money. You have to make a profit. If you net a 20% profit because of that million, then borrowing at 6% made sense, right? After tax, right? Don't forget the weighted average cost of capital after tax, blah, 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 blah. I'm not going into that. I'm just saying, very simple. If you're guaranteed a 20% return, borrow as much money as you can, because if you can make it happen, you can make it happen, right? This is not personal financial advice. This is just educational content, by the way. Debt isn't really that scary, and it's often a lot cheaper than equity because equity is more permanent, right? And we're always thinking about risk and reward, not just in terms of the numbers, but in terms of the commitment with somebody else. And when you give up your equity, you're responsible to report to that shareholder forever until you buy them out or they exit the business themselves. Like, let's do the math. If you give up equity, right? You give an investor 20% of your company for $500,000. Your company eventually sells for $20 million. That investor is 5xing their money at a minimum. They're going to get $4 million, and that $500,000 cost you $4 million. But if you do debt, you're borrowing, right? So it's non-taxable. You reduce your tax, right? When you pay it back, you're paying interest. It's non-taxable. You pay back $550,000 over 2 years. Company sells for $20 million. You're keeping the difference of $4 million and the amount that you borrowed, less the interest, of course. But that's not taxable. So now instead of getting taxed on whatever, like $4 million, the investor's going to get taxed on it or whoever, you're only taxed on this too. This is why debt is so special in the American economy. If you go to Europe or most of the other countries, lenders. And I hope I'm explaining this well. Please think about this. If you go to any other country, they don't have the financing that the US has. And it sucks, but it's just a reality. American finance system is about debt. You want to be leveraging debt. Obviously, you need to show returns. You need to show proof of income. There's certain things that lenders want to see. But if you can get past that hurdle, it's a no-brainer. So this is why equity might be more expensive than debt. And here's typically when debt makes sense versus when it doesn't. If you have predictable revenue, if you have assets that have a trade-in value and a legitimate trade-in value, you have a clear path, you have a budget, you have a forecast, you have everything, the sensitivity analysis, you've crossed all the T's and I's. If you have a path to pay back the interest and you don't want to give up ownership in the business, right? Take on the debt. You really want to give up ownership when you have strategic partners that can increase the value of the company. Or if you're going to do M&A, mergers and acquisitions, like there's no reason to give up equity when you can just take on debt and just manage it appropriately. You have the money to now grow your business. Go invest that money. That's what the money's there for. Don't be an idiot with it. Grow your money, but it's better than equity. It's a lot better. You can pay yourself more too. But debt also doesn't make sense when you have no revenue. You don't have a way to pay it back. There's no path for that. And you're in a high risk, high reward bet. So you just need to understand what business you're getting involved in before you start making these decisions. But debt is one of the best ways for Americans, at least, to become financially independent and be business owners and build equity. It's just like a house, but you need to show a path to paying back the debt. If you can't do that, don't do it. It's not a dirty word. Borrow the money, keep your company. This is why budgeting is so important. This is why you have to understand your customer acquisition costs. You have to understand a lot of other things as well that I talk about in other videos, but it's not such a bad thing. But you also have to know when to walk away. Knowing when to walk away is half the battle because there's tons of lenders out there, different banks, different people, and you have to really understand the private marketplace. This is where experience and network will really help you go further because you'll be able to get special deals based on your reputation, based on the people that you know. At the end of the day, it's people lending to people through a certain contract. You have to know your worst case scenarios and when too much debt doesn't make any sense. Same thing for equity, but you just need to know as a CEO when to walk away. CFOs help CEOs do that. That's what we do with all of our CEOs. We're fractional CFOs. We come in, we work with CEOs, and we help them make these types of strategic decisions to help them scale their company and make their business a self-sustaining asset. But you can't do that without knowing your numbers. The best time to get an umbrella is before it rains. And that's the same thing for when it comes to raising money. A lot of capital raisers, even on Instagram and whatever, will say, I raised X amount of dollars. Well, how much of that was debt and how much of that was actually equity? A lot of these guys are shysters. They're saying I raised all this money in equity. The reality is they raised a bunch of debt, and it's a lot easier to raise debt than equity. And it's something that you should keep in mind as a CEO so you don't get caught up in the headlines and all the clickbait. The best time to raise money is when your numbers are going up and you don't actually need it. It's when the runway is good. It's when the unit economics are good. It's when you don't need it. It's when a lender is willing to give you any kind of money at any kind of rate just because they want to have a piece of your business. The worst time to raise money is when you're about to run out and you're panicking. So you should start fundraising if you have 9 to 12 months of runway left, not 3 months, not 1 month. It's too late then. The mistake founders make all the time is they think they'll raise when they need it, but then you're negotiating from a position of weakness, and who would want to do that? It's the same thing for clients that come to us and they're like, hey, my business is falling apart. Can you fix it? Most of the time, yeah, we can. Does it suck? Yes. Is it costly for the founder too? Yeah, because we ask for equity because we know we're going to scale the business. It's better for us to, if we're going to put in that sweat equity, all that work to scale it with a piece of the pie. So it's kind of like going back to that chart. If you want something, you're going to have to give up something, right? The best way to do things is when you're in a position of strength. So how do you actually raise the money? The first thing that I think founders and executives really undersell is the story behind the company. Like, what is the whole point of this? Like, can I as a lender or as an investor really get behind your message? Have I seen the same problem appear in my life time and time again? Is there a market for it? Why you as the founder? Like, these are the questions that you have to ask for startup capital, but also for lenders. Like, lenders are going to sit down and talk to you. They're going to want to know who they're lending their money to because their job is responsible for how well their loans are going. So you want to be engaging. You don't want to be a boring, okay, here's the data, blah, 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 blah. I'm not really passionate about the business or the problem I'm solving. You as a lender shouldn't really feel so motivated to write me a check as quickly as possible. It's because you're boring. You don't have a good story. You don't have a good deck. You don't have a good team. You're not making it engaging. So this is actually really important. You need to think about making it engaging engaging story and really having that mission statement in your company. Then you need to have a clean data room. The messier your finances, the messier your company. I've seen this time and time again. I've seen this with companies worth $50, $100 million plus. Their financials are all over the place. Enron, publicly traded companies, financial fraud. The messier the finances, the more something smells up. Something smells wrong. I smell smoke. I'm going to get out of the room. When investors look at your company, the first thing they're going to see is your data room. And if it's a mess with random files, missing months, statements, numbers that don't reconcile, they assume your whole company is run that way. But if you have a clean data room, that's something that we build with our clients. You have organized folders, up-to-date financials, clear metrics. They're like, okay, this guy knows what he's doing. At the end of the day, we want to know that you know what you're doing, right? If you're a lender or an investor or whatever, we want to know that, right? Money comes with superpowers too. You shouldn't just think about getting money. A lot of people, especially first-time founders, fall into the mistake of signing anything they can. They'll sign their kidney just for a $250,000 check. That's not the way you want to run the company. The question you should ask about an investor or even a lender is, what do they bring to the table besides the money? And if the answer is nothing, that's fine, but make sure your terms are better. You should make sure your terms are better because there are people out there that could 10x your distribution. And then they might give you harder terms because they can do something great for your business and they want a bigger piece of the pie. But if you can 10x with one investor and their check, like Shark Tank, you're probably going to do it. That's why people go on Shark Tank. So the mistake founders make is they take money from whoever offers it first without asking what else the investor or lender brings. Financial investors give you money. They want a return. That's it. They might even package it up into a product and then sell that to other investors. Hashtag Blackstone, BlackRock, JP Morgan, Goldman Sachs. All these people give you money, want a return. That's it. Strategic investors. And by the way, this isn't just going out and saying that. I'm sure that they have like their own team of people that help you and they're strategic as well. But like on paper, that's what I see. Strategic investors give you money. They give you customers, distribution, expertise, credibility. Venture studios, Green Mountain Advisors is one of those. But you also have Andreessen Horowitz. You have Y Combinator. There's strategics that, write a check, but they also help you actually become successful because you probably have blind spots and there are certain milestone-based KPIs or commitments that you have that will unlock the next funding round. With strategic investors, they're going to want to see milestones done to allow for the next round. And that's kind of how they play the game. That's how they sell the story and they make the company grow. That's more like momentum, right? Financial investors are mean reversion, going back up here. Mean reversion versus momentum, right? Strategics are more momentum. Financial guys are more mean reversion. They're more like, oh, we want stable cash flow. In essence, as a recap, the 10 strategies that we've gone over are the capital stack, know all your options, momentum versus mean reversion, which type of investor is going to fit that business model, your unit economics. Can you prove that one customer works before asking for money? Debt. What types of debt beat equity? Data room. Please build a good data room. Know when to walk away. You should have your walk away number too low, your floor. Don't take a bad deal. It's better to not have any traction in your business than to take a bad deal. I've seen so many companies lose their entire business from a bad deal and it just ruined it. And it was such a good potential, but they just ruined it because they couldn't say no. You have to know how to say no. You should raise your money early, get the money when you don't need it, have strategic and financial sponsors, have a great story, and start to build connections with these people 18 months before you even need them, right? So we're talking about 2 years before you actually even need the money. And that means that you're a business owner and an executive that can visualize the future and you have the foresight to start managing your risk and managing for the future appropriately. And by having these habits in place now, you'll find it so easy to raise money. It's so much easier once you have all these things in place. And we do that at Green Mountain Advisors. If you like the channel, subscribe. If you like this video, give it a thumbs up. If you want to talk to us, click on the link in the description in the bio below, and I'll see you in the next one.